All right, so when someone first comes in and sits down with me, the one thing that the lender, and when I say the lender, I'm not talking about myself, these loans are sold on the secondary market and they want to make sure that these loans are going to perform. So they're really looking at the buyer's ability to perform. What's their buying power? How stable are they? How long have they been on a job? How consistent is their income? Are they going to have the ability to pay this loan back relative to what debts they have now with this new debt? We don't want to see them or set them up to fail. We want them to have a good experience and invest in the future through home ownership. So they're looking at all these various things to make sure that you're going to be able to perform on making the monthly payments. And so they look at the different things. And a few that come to mind really is, like I mentioned, your income. How stable is it? Based on your monthly income, they look at a percentage of that income. They like to see, and I'm talking roughly about 30% of your gross income, not what you take home, but your gross income can go towards a mortgage payment. And about 15% of your income could go to other incidental monthly payments, a car payment, student loans, credit cards, that kind of stuff. So you don't want to be more than about 45% of your gross income for your total household liability. And that's kind of what they're looking at. So you can kind of figure that out on your own before you even talk to a mortgage professional. But at the end of the day, the most critical part is, what do you as a consumer feel like that you can afford on a monthly basis? Sometimes when I say, yeah, your back end ratio is at 45%, and they're like, yeah, no problem. And other people, I say it's 45%, your monthly payment's going to be this. They're like, there's no way we can make that payment. And that's what's most important. You need to make sure that you're going to make a payment that you're comfortable making for the next 30 years of your life. And I know that was a lot. When I first bought my home, it was $100,000. I couldn't believe that I was going to be paying this much. But, you know, the cost of living's gone up and everything. When I look back and reflect on that, I was like, man, that was a drop in the bucket. So it is a bit of a pinch at first, but you don't want to set yourself up to fail. You want to make sure that you're going to be able to make that liability and pay that payment back. So you have the last say on this stuff. You'll hear information from a mortgage professional or from us on what you qualify for, but you need to make sure you're comfortable with that.